Okay, let's go to London now. Thank you, Dennis. For more on the state of the Eurozone, we're joined by Ashraf Laidi. He's Chief Global Strategist at Citi Index, and he joins us from London. Thank you, as always, Ashraf, for joining us. What are you looking for in the Fed minutes of later today? That, of course, was the meeting. The minutes will be the minutes for the meeting at which the word patient was at last dropped from the text. What will you be looking for in those minutes?
Well, the interesting thing is that when the minutes, when the decision came out from the Federal Reserve, everybody was looking at whether patient was going to be there or not. And the second that they were released, the market was able, or at least the currency market, sold the dollar because they were able to immediately see through the removal of patient, which was supposed to be dollar positive, but they saw through that and they read the statement, and the statement downgraded GDP growth. It played up international developments and the Eurozone in China and the strength of the dollar. And we're able to see through the downgraded forecast and the dot forecast of CPI, of PCE, inflation, and GDP growth. What does this mean? If the market was immediately able to translate that as positive for equities and negative for the dollar, because despite the removal of patient, basically the statement and the forecast signaled probably a delay in the rate hike, then maybe we could see more of that argument. There will be more arguments in the minutes, more detail as why the GDP forecasts were downgraded and the core PCE price index was downgraded. And basically that may be quite, that may lead to some selling in the US dollar.
What was your read of the disappointing non-farm payrolls number that we got on Friday? Have you adjusted your view on when the Fed may raise rates?
Well, I'd like to remind the program, every time I come in the program, and I remind them, tell them that we do not expect at all a Fed rate hike this year. We think that the market cannot handle it. We think that even if they do a 25 basis points rate hike, then the implications and the repercussions of further dollar strength will bear badly on on the U.S. multinationals and on the emerging market nations, especially the Chinese companies that have borrowed so much in U.S. dollars. Having said that aside, that we don't expect a rate hike, what the market seems to have moved firmly away from a June rate hike after the NFP, after disappointment, and gone into believing that there's going to be a September rate hike. Had you invited me 2 days before the NFP, we were all over the media and saying that the March payrolls usually have a bad record that come out in April. 67% of the last 17 years, NFP payrolls have disappointed, have come around 30,000 to 40,000 below expectations. So had you invited me to your show, I would have advised your well-esteemed viewers of that disappointed figure. But average hourly earnings came up. So it just shows that it's an aberration, that the number is an aberration. And as long as average hourly earnings went up, it does not get rid of the notion of a rate hike. It just delays, according to the market, again, the notion of a rate hike. Obviously, if we do see two more numbers below 200,000, there will be no more rate hike expected this year.
Ashraf, it's Dennis Mitchell. I'm just curious, because if you think we're not going to get a rate increase this year, next year is a presidential year, and history has it that the Fed likes to stay out of the market during presidential years. And then keep in mind, we're at emergency levels, crisis levels on the Fed funds rate. And, you can question the strength of the U.S. economy if you like, but I think we'd all agree that we're nowhere near 08 and 09 levels. So if not this year and next year, when do you anticipate a rate increase?
Absolutely. Absolutely. I agree with you that, listen, it is madness to leave interest rates the same way where they were in 2009 when unemployment was above 9 or 10%. It is not right to leave interest rates the same way where unemployment was much higher, where payrolls were much lower, and so on and so forth. That is true. But here is the thing. I think that what we may see, and I'm sure you've heard this already, we may go into an environment of 1998. 1998 was an environment when the U.S. economy was doing very well. The Fed may have been ready to raise rates. Then they came out with those three rate cuts in September, October, and November of 1998, and not because of the U.S., but to save the world economy. LTCM, Brazil, Russia, Asia. And international development is back in the FOMC statement for the first time. Never has the word international development been put in there. Maybe we are wrong. Maybe there will be a 25 basis point, like a token rate hike. The thing is that, listen, guys, the stock market, the S&P 500, the Dow Jones Industrial Index had not had 3 consecutive daily gains since mid-February. Yesterday, the market was up for 95% of the entire U.S. session. We saw that's it. That's it. Finally, we're going to see a 3-day gain. In the last 20 minutes, boom, it dropped, and we still do not have a 3-daily gain. This does not show a sign of a healthy, convincing bull market. The same thing with the U.S. dollar. The U.S. dollar, which is expected to have higher yields. When was the last time we saw 3 or 4 consecutive daily gains in the U.S. dollar against the euro over the last 2 weeks? There is something wrong. There is something that smells funny in the markets. And guess what? A 25 basis point rate hike may not be anywhere near just a token move. It will not be handled. It will not be handled very well by the market.
Ashraf, good to talk to you. Next time we reach out to you, we'll do our best to get you before the non-farm payrolls numbers are released.
Make sure.
Thanks for joining us.